now this information will populate the note over here. So if we look at our trial balance, what we'll often see is if we receive a payment on a note, we're going to say, well, is cash affected in that transaction? Yeah, of course, what happened when we received a check, a payment. So cash has a debit balance, we're going to make it go up, we're going to do that by doing the same thing to it, which in this case would be another debit. Now, we don't know how much of that is in this problem yet because there's interest on the note. But we do know what the note was for because it's right there now, and it's right here. That's this note that we started with, and therefore it would be on the books, and we'd say, well, they just paid that off, so that one's got to go down. That's a debit balance. We need to make it go to zero, so we're going to do the opposite thing to it, which in this case would be a credit. So I'm going to copy that. We know we're going to credit that for the amount that's in there to make it go to zero because it's been paid off, 14100, just like accounts receivable would. And then the thing on this one is that, remember, in this transaction, we had to calculate how much interest was accrued as of the cutoff date. That is the Chapter 3 kind of adjusting entry where we had to recognize this revenue last year in 2014 because we had to make the financial statements as of 2014. So now we've got this interest receivable kind of hanging around over here because we recognized the interest last year even though we didn't get it yet. Now we're going to get it, and therefore that needs to go down to zero. That's debit balance. We're going to do the opposite thing to it. I'm going to credit that. So I know that's got to be credited for the 41 as well. Now we also know that the interest on the full term of this note was 165. So if I wasn't worrying about the cutoff date, then we're collecting interest in total of 165. So that means that if we already calculated 41 of it last time, the amount of interest here we're going to need, I'm going to flip the sign with a negative, I'm going to put brackets around it. It's the 61 minus the 41. So the interest we're recognizing this period, the interest that we earned, the rent on the money that we loaned out to this client, we earned 123. How do we get that? It's the 65 minus the 41. Then we flip the sign to make it a negative. So how much are we going to get after in cash? Well, we can think about it this way. We're going to get the principal, which is 14.1, plus the interest of 165. That's going to be how much cash we're going to get, but we had to break out the interest between the time periods in which we received them. So we can also do that with the negative sum function. I say negative sum of these. And that's one way of summing these up and then flipping the sign. So if I add these up, it comes out to this number and make it a debit. Therefore, if I add them all up, the debits minus the credits equal 0. Now, if we were to post this, then we would say that we got cash. I'm going to put my cursor in T5 equals the debit. That's a debit. That's a debit. It's going to make the debit go up in the debit direction. Here, put us out of balance here. Then we can go to the notes receivable for Todd. So they owed us that much. I'm going to put my cursor in the middle in T12 equals the credit. That's a debit. That's a credit. It's going to make that go down. And then we got our cursor in T13 equals the 41. That's a debit. That's a credit. It's going to make this go down. And then we're going to go to the interest receivable here in T17 equals, and that's revenue. So it should be the revenue down here. So equals or plus this 123. That's revenue. That's going to make the revenue go up when we hit enter. So revenue actually went up in this case. So what happened here? These are all income accounts. So the income basically went up. It went from here up to here by the interest that we earned on that. And we're back in balance here. Our accounting equation is in balance. Next transaction's on 3.2. So we're going to say 3.2 accepted a 627% 90-day note dated this day in granting a time extension of past due accounts receivable from midnight. All right, so what happens here is if we make this large, we're looking at midnight owes us this 6.2. He's not paying us. Therefore, we're going to move that from the receivable to the note. Why? Because we want to charge interest on the transaction for midnight. So we're saying midnight, that's fine. You don't owe us money. You didn't pay us. What we're going to do is create a note for you, and you're going to owe us both that money and interest on top of it. So therefore, what's happening is the receivable needs to go down, and the note needs to go up. So we're moving it from the receivable to the note. The receivable has a debit balance. We're going to make it go down by doing the opposite thing to it, which is a credit in this case. So I'm going to credit the receivable for the amount that is in there. Midnight is 6.2 in that receivable. So we're going to say the receivable is going to go down by 6.2, and we're going to debit something 6.2, and it's going to go into the notes receivable rather than accounts receivable for midnight. So this is an asset. We're going to make it go up by doing the same thing to it, which would be another debit. This has a debit balance. We're going to make it go up with another debit. Now, so this doesn't seem like a big difference of a transaction. We went from one receivable to another. The reason we're doing it so that we can track the interest in this receivable because these amounts are past due. So we're going to say, okay, the notes receivable for midnight then in T9 equals the debit. That's going to make the note go up. Then we're going to go to the accounts receivable in T6 equals the credit, and that's going to make the accounts receivable go down. Now again, in real life, we wouldn't probably track the accounts receivable by name here. We'd have a subsidiary ledger over here, and we're saying, okay, midnight owed us this much money, and that amount should go down, so I'm going to credit that by the same amount here. And that will mean that our totals here for the people that owe us money now ties out to the total here. Next one, on March 17th, so we're going to say 3/17, accepted a 3/8 90-day 7% note dated this day granted to Ava a time extension. So Privet time extension for past due receivable. So same thing is happening here. We're saying that accounts receivable is not being paid, therefore we're going to move it from here to the note receivable. Accounts receivable has a debit balance. We're going to make it go down by doing the opposite thing to it. And we're going to put it into another asset, which is a note receivable. And we're going to copy that and paste it here because it has a debit balance. We're going to make it go up. For how much? Well, if we take a look at Privet here, owes us, according to our subsidiary ledger, 3/8. So we're going to say 3/8 is going to go into the note, and it's going to go out of the receivable. That's the debit and the credit. Why? Because we want to charge interest on Privet. Again, they didn't pay us, that's fine. What we're going to do is we're going to move it to the note. We're going to charge you interest on it, and that's how we'll deal with the past due amount. So we're going to go over here. We're going to say this equals in T11 equals the debit, making the note go up. And there's something in receivable, so I'm going to double click on it. I can see what's in there. I'm going to go to the end of it. I'm going to say plus. I'm going to point to the credit in receivable, making it go down. Now this doesn't match our subsidiary ledger because we also need to make it go down in terms of Privet account over here. So we're going to credit that in this area as well, the receivable, making the amount they owe us go to 0, bringing us back in balance, meaning this matches now what's on our trial balance. So then we're saying, here we're saying Privet dishonored her note when presented for payment. So now the note is not happening, and I'm not exactly sure why this is, but we're going to move it from the note now plus the interest that has accrued back into the receivable. So we're saying, okay, we'll take the note plus the interest that you owe that has now expired and is now due, and instead of making another note, we're going to put it back into the receivable for you, and we will extend, give the normal 30 days on the receivable before putting it into another note. And so the note has expired, we didn't get payment on it, and we didn't make another note. We're going to put it into the receivable in this case. So now it's going to go from the note here that we have it in now to the receivable here. So we're putting it back into the receivable. So the receivable has a debit balance. We're going to make it go up because we're moving it back in there. So we're going to do the same thing to it by debiting the receivable. And we're going to take it out of the note here. So here's the note. We're going to take it out of there. So I'm going to copy that. And that's going to be the credit amount. Now, the credit we know has to be for this 3/8 because the note's got to go down to 0. So I'm going to credit that negative 3800. But the debit to the receivable is going to include interest. So we need to figure out how much interest on the note we have before we know how much to move back into the receivable. And we calculated that over here. So we're saying note here. We did that first actually, which is kind of weird, but that's okay. And that's the 22 here. So we are going to say that the calculation here is going to be in this case, interest revenue, because we earned that money. How did we earn it? Interest revenue, I'm saying. How did we earn it? We loaned someone money, just like if we loan someone a house or some place to live. They owe us rent on it. They owe us rent on the money we gave them. That rent is $22 right now. So we're going to say the rent on the money that you've been using that's really ours is 22. Now note, I could say this. I could say it's a negative of that number here. And we did that up here up here. But note that if I do that, it could do some funny things, because remember that number isn't really 22, it's 22.1. And if you're going to try to put in a connect, you might want to not deal with rounding, and in this case put negative 22. And that's just something you got to always keep in mind, because if I put 22, if I say this equals that number, it's really this number, and then this number's off by a couple pennies, and that could throw your balance off by a couple of dollars after a while of rounding issues. So if we highlight that and we say, okay, then that adds up to 3822. That's what we need the debit to be. We're going to move 3822 in here. We could do that with our formula, negative sum formula, which I prefer doing. We're going to sum that out and make it negative. If I highlight all of it, now it equals 0. Then we can post this out. So we can go say we're going to the receivable. Something's in it. So I'm going to go ahead and double click on it. Go to the end of it. Plus, go to this 3822, enter. That makes this go up. Puts us out of balance here. And we're also out of balance here. So right at this point, I'm going to say now we have Privet owes us 0. Now they owe us more money again. So we're going to say that is this money, and we're going to give them another 30 days to pay that off before we take our next collection action. And so then the notes receivable are going to be here for Privet. There's something in it again. I'm going to double click on it, go to the end of it. That needs to go to 0 because we put it back in the accounts receivable. So we're going to credit that, and that'll make it go to 0. And then we're going to go to the interest. There's something in it. I'm going to double click on it, go to the end of it. Plus, we're going to go to this credit. This is a credit, this is credit, making it go up. And that makes our income go up. We've earned 145 of interest income. So we have a similar transaction here on June 2nd, where midnight, another customer refuses to pay the note that was due on May 31st. Prepare a journal entry to charge the dishonored note plus accrued interest to Midnight Company's accounts receivable. So once again, the note became due. We said, you owe us this plus the interest, and they didn't pay us. So instead of making a new note right at this time, what we did is we're just going to move it back into the receivable plus the interest on the note. So that means that accounts receivable is going to have to go back up, and the note for Midnight, which is here, they owe us 6.2, is going to have to go down. So I'm going to say the accounts receivable is going to go back up. That's a debit here. We're going to make it go up by doing the same thing to it, which in this case would be another debit to accounts receivable, and then we need to make the note, which is a debit, go down. So we're going to do the opposite thing to it. So we're going to copy that, and that's going to be a credit. Now, I don't know how much we're going to put in the receivable because it's going to have to include interest, but we do know that that needs to go to 0 because we're taking it all out of there and putting it into the accounts receivable. So this needs to be 6.2, and then we're going to have to account for the fact that there must be interest on this, which we calculated over here. So now we had the midnight note at 7%, so they owed us this, and so the interest at the end of the day on that was this 109. So then I'm going to say that they owe us interest, and the interest is revenue. So revenue is here, has a credit balance. It's going to go up because we earned it with a credit. So it's a negative 109, or a credit of 109, and that means that the new, well, I should put that down here in the negative 109. That's going to be revenue that we earned. That means that the new receivable, how much do they owe us? The original principal plus the interest of 6309, which I'm going to put in here with a negative sum function again. That means that the debits minus the credits equal 0, and then we can post this out. So once again, it's going to go into the receivables. There's going to be a lot of stuff in the receivables, but note, we can see every time it has receivable here, it's going into there. We're going to go to the end of it, plus, and we're going to enter the debit here. That'll make this go up, puts us out of balance. We're out of balance over here, so I'm going to go ahead and post this on this side as we go now as well. So Midnight is here, and Midnight now owes us, Midnight is here, and Midnight doesn't owe us anything as of now, and now they owe us another 3.6, so we put this back on the books at 3.6. So he owed us here, we took it off, and now we put it back on, and that evens us out. And then we're going to say Midnight here, double click on it, go to the end of it. That's going to be a credit, which will take that down to 0, hopefully. Takes that to 0, and then we're going to record the fact that we earned interest on it again. It's kind of scary because we might not collect on it. This is kind of scary. We're not collecting our money. But if they do pay us, we're going to get another $109, which will increase our revenue. And then finally on July 17th, received payment from Midnight Company for the maturity value of the dishonored note plus interest for 46 days beyond the maturity date. So, whew, they paid us. All right, so that means that we got the money now. So cash